This conference will now be recorded.
Okay, thank you so much for joining us for the 2019 Retirement Planning Considerations webinar. For those of you who don't know who I am, my name is Jenna Witherbee, and I'm one of the advisors on the team at 401k Plan Professionals. We focus 100% of our time on corporate retirement plans, serving both the plan sponsors who administer the plans, as well as the people who participate in the plans. So today's webinar is a part of our webinar series. About 6 times throughout the year, we're going to spend around 15 minutes discussing a variety of topics, not just pertaining to the 401k, but we want these to provide value to as many people as possible. You can, of course, catch the webinar live, as well as the recording link will be posted afterwards to our website and our YouTube channel, as well as emailed out. So we want as many people as possible to benefit from this information. So today's topic is 2019 retirement planning considerations, and we thought it was very timely just because we're in the first quarter of the year, we're in February, and so this is for a lot of people the time of year when they're thinking about their finances, they're wrapping up the books or the budget from the year prior and doing their taxes and maybe making some financial decisions for this upcoming year. So here's a few things I'm going to talk about today, different ways to save for retirement, and I want to highlight the new IRS limits for this year, some notable deadlines, considerations when it comes to saving with pre-tax or after-tax dollars, and then asset allocation and rebalancing. So first of all, different ways to save. We work in the 401k space, and so we're very passionate about 401k plans, and we could probably spend an entire day talking about why those are so great and we see the benefits in them. But there's other ways to save, like I said, and I wanted to highlight a few of the more common ways that people are saving for retirement, as well as give you the new limits. So first and foremost, employer-sponsored 401k and 403b plans. The limit for 2019 is $19,000. Plus, if you're over age 50, you can put in an additional $6,000. Individual retirement accounts, both pre-tax and after-tax, have limits of $6,000 for this year. That's up from $5,500. And then if you're over age 50, you can put in an additional $1,000 per year. Health savings accounts. So HSAs are becoming more popular in general, and they've been something that we've even been talking about because besides being a great vehicle to save money for medical expenses, they're also a great way to save for retirement because the dollars that have been put in and have potentially grown over the years, they can be used post age 65 as just regular retirement dollars. You just pay regular income taxes on them. And so people are viewing them as kind of a secondary 401k, basically. So if you are covered under a high deductible health insurance plan, you can have an HSA account, and if you have individual coverage for this year, you can put in $3,500, and then if you are on family coverage, you can put in $7,000. Once you're over age 55, you can do a $1,000 catch-up contribution. So IRA phase-outs. I want you to know that individual retirement accounts do have, I talked about the limits, but they do have a number of income phase outs to think about. And this is a very wordy slide, but when it comes to traditional IRAs, I want you to know everybody can contribute to the IRS maximum. However, if you earn too much and if you or your spouse are covered by a workplace retirement plan, the deductibility of that IRA may be phased out. So I'll explain what I mean. In 2019, if you're filing single or head of household and you're covered by a workplace retirement plan, in other words, you have access to a 401k or a 403b plan, and you have modified adjusted gross income between $64,000 and $74,000 or more, the deductibility of your IRA will be phased out. Similarly, for married couples filing jointly, in which the IRA contributor is covered by a workplace retirement plan, the income phase out is $103,000 to $123,000. And then for an IRA contributor who's not covered, but if they're married and their spouse is covered, the income phase out is $193,000 to $203,000. So a lot of numbers here, but I wanted you to know that there are these different subsets. Now, if you are not covered by a workplace retirement plan and you're single, or you're married and neither one of you are covered by a workplace retirement plan, then you can contribute the maximum and the entire thing is deductible. The phase outs just come into play if you are already covered by a plan and if you earn over a certain amount. Now, Roth IRAs, those have income phase outs just to contribute into them. So not everybody can contribute to a Roth IRA. In 2019, the AGI phase out for singles and heads of households is $122,000 to $137,000. And then for married couples filing jointly, it's $193,000 to $203,000. So a really good rule of thumb is to increase your contributions periodically. This is something that we educate on all the time. Everybody is different as far as what system works best for them, but a lot of times people increase their contributions if and when they get a raise, maybe when they file their taxes, maybe a certain time of year, so every January it's top of mind for them. Those are just examples, but sticking to that habit of constantly increasing what you're saving is a very good idea. Here's just an example of how that 1% difference can accelerate over time. So this is assuming a $40,000 annual salary increases of 3% every year, a 6% rate of return compounded annually, and the specific contribution amounts down below. This is also saving over the course of 40 years. So on the far left, if I were to save 5% the entire time, yes, I have accumulated about $468,000. If I would have gone to 6%, that goes all the way up to $560,000. Now, if I would start at the 5 and go 1% more each year until 10, I hit $880,000. Similarly, if I then continue to 15%, I'm already at $1.2 million. So at the time, it might not seem like huge dollars and a big amount, but over the years and compounding and growing, this money can really add up. Here's just some other examples of small, maybe purchases that we don't think twice about, that we maybe make, but instead of spending that money on things like a vending machine visit, a coffee, or going out to lunch, if we were to think about increasing what we save for retirement, investing it over the years, this example is over the course of 30 years, you can see that these purchases add up to large amounts. Next, I wanted to highlight some notable deadlines. So April 1st is the deadline for required minimum distributions for 2018 to be taken out for those that needed to take their first one for 2018. So once you are retired and you're over age 70 and a half, that's when your required minimum distributions are triggered. And so if your first one needed to be in 2018, you have until April 1st, kind of a grace period to get that first one in. April 15th is the deadline for 2018 IRA contributions as well as employer contributions for 2018 unless they've filed a tax extension. And then December 31st is the deadline for 2019 required minimum distributions. For those that need their first one, though, in 2019, they have until April 1st, 2020. So if you've noticed, there's two different ways to save for retirement. One is pre-tax and one is after-tax, in other words, Roth. And the main difference is whether you pay taxes now or you pay taxes on the money upon time of withdrawal. So why would somebody consider saving with Roth dollars? There's a few different reasons. If you think your income will be higher in retirement, if you think your tax rate will be higher in retirement, if you overall require or desire tax diversification, or maybe you can't even do a Roth IRA because of your income, so therefore you want to contribute into your Roth 401k. Those are the more common considerations that we see. There is no necessarily right or wrong just because we don't have a crystal ball, so we can't say for certain what our taxes are going to be when you retire, what are your income needs going to be when you retire. However, using the information that you tell us and asking a number of questions, we can typically arrive at, our best estimate of what would work best for you. Another topic is asset allocation and rebalancing. So asset allocation is a technique that tries to balance risk by dividing assets among different asset classes. So different sectors of the stock market perform well at different periods of time. Sometimes it's the large tech stocks, sometimes it's the small banks, sometimes it's energy, sometimes it's healthcare. So asset allocation is spreading your money out to reduce your risk. Our goal is always to be proactive when it comes to managing risk within a portfolio. And our viewpoint is if you're invested properly for your age and your risk tolerance from the get-go, then you should be able to remain calm and not panic when we do have market volatility. Rebalancing is another concept. This is something that can be done either on a manual basis or with a lot of systems, it can be set up automatically where it brings you back to your intended investment allocation. And that's what this graphic is describing. This person has 4 different investments, 25% each. Over time, they've shifted because they've performed differently. So then they became 23, 20, 30, 27, but rebalancing brings them back to the 25% in each investment. This is something that we use to describe to people and educate people on why keeping your time horizon in mind is so important. And so this is looking back from 1950 to 2017. If you focus on the green bars, that's looking at a portfolio fully in stocks. And over on the left-hand side of the page, we're looking at 1-year rolling periods and 5-year rolling periods. And you can see that the volatility over the years is really high in the shorter time frames. So if you have a shorter time horizon until retirement, you probably then don't want to be fully in the stock market. Versus on the right-hand side of this page, we're looking at longer time frames, a 10-year rolling time frame, a 20-year rolling time frame. And so you can see that volatility decrease. In fact, in the 20-year time frame, stocks have never had negative performance. And so while this slide might be kind of technical, this is really the foundation and the reasoning behind why we say what we say when it comes to age and your overall exposure to the stock market. Here's another graphic that we use from time to time. It's showing the 9 main sectors of the U.S. stock market and how they've performed over certain periods of time. And so you'll notice no 2 sectors are ever the same. This is just speaking to what I said about diversification. Different asset classes perform differently at different periods of time. And so you want to spread your money out. Don't put all your eggs in one basket. Don't chase performance. And overall be spread amongst these different categories. So again, here's the topics that I covered: different ways to save for retirement, the new IRS limits, some notable deadlines, pre-tax versus after-tax, and asset allocation and rebalancing. If you ever want to reference this webinar down the road, you can go to our website, 401kplanprofessionals.com. You can go to our YouTube channel, search us at 401k Plan Professionals. Subscribe today to our YouTube channel if you haven't yet. You can just find us and hit the subscribe button, and that will give you notifications anytime we upload a new video or new content. Thank you again so much for joining us for this webinar. I hope you appreciated the information and it was valuable to you. Definitely reach out to myself or a member of my team if you have any questions. And we hope to see you next time for the next webinar in April. Thank you.